Joining us now in an exclusive interview is Ares Management CEO Mike Arougheti. Mike, welcome back. It's good to see you.
Great to see you too, Sarah. How are you?
I'm good. I'm wondering about some of these management changes. A lot of the analysts are writing about the news of the day. So you have two new co-presidents and made a series of leadership changes. What is the thinking behind all this?
Look, Ares has been, enjoying some significant growth and globalization, and I just feel so fortunate to have a long-standing partnership group here that's been by my side for 25 years. Obviously, I still have a lot of gas in the tank and a lot to do, but the opportunity to elevate Kipp, deVeer, and Blair Jacobson to co-presidents, I think it's just a huge opportunity for us to accelerate into a lot of the strategic opportunity that lies ahead of us.
So let's talk about some of that strategic opportunity. What are you most focused on right now that we've seen a real change in the environment and with the new administration, policy changes too?
Yeah, look, we want to be policy aware, but one of the benefits of being in the private markets for as long as we have is we know that we can deploy into really attractive opportunities regardless of the administration, regardless of the economic backdrop, and regardless of the rate picture. The good news is we're coming off of a record year in 2024. Obviously, we were able to deploy over $100 billion, which was almost 60% increase from the prior year in a world where M&A volumes were significantly muted. So I think the breadth of the platform now is allowing us to be a real interesting creative liquidity solutions provider into the global markets that we participate in. The pipelines that we're seeing in the markets are building. So I do think that with the change in administration, there is an enthusiasm in the markets. A lot of the pent-up demand that we expected to see come off the sidelines is in fact coming off the sidelines. So I would expect 2025 to be another meaningful deployment year for us as well.
And when you say providing liquidity, are you talking about private credit? Is that still the golden opportunity?
Yeah, it's really all over it's all over the map right now. I mean, I think the good news is if you were to look at our deployment in 2023, it was dominated by private credit just because the equity markets were still thawing. I think valuations were uncertain. The rate backdrop wasn't clear. Bid-ask spreads between buyers and sellers were still pretty wide. As we got toward the back half of 2024, we saw the secondary market pick up dramatically, so we're seeing good deployment there. The real estate markets are thawing, and so we're now beginning to see good deployment in both real estate equity and real estate credit. So I think 2025's deployment will frankly be a little bit more balanced across the various products and less private credit heavy.
Do you see any change in data center demand, given you've been involved in digital infrastructure after some of the revelations with DeepSeek and now questions about just how much it's going to cost and how much we're going to need in terms of infrastructure?
Yeah, I think history would tell us that as the cost and efficiency of technology and compute improves, we'll actually see a pickup in demand. I always remind people that if you look at data center demand today, it is dominated just by cloud computing. And obviously the transition to AI is a meaningful growth driver, but it's not the only growth driver. We continue to be focused on long-term relationships with the highest quality hyperscale counterparties in major metropolitan areas. Most of the data center pipeline that we're working on now is entitled, powered, leased, and on its way to financing. So the size of the opportunity is so significant that even if we saw a reduction in demand or a slowing of the pipeline, it's still a significant investment opportunity for the private markets.
Yeah, we just had a conversation looking at some of the commentary from, say, Alphabet last night, Mike, that it remains very much a race and not one that one side can easily cede to a rival. Would you say that?
I'm sorry, Carl, I had trouble hearing you on that one.
I was just going to say, whether it's the land or the power, the race is very much on, even with some of these new evolutions in the trajectory of the technology, like DeepSeek.
Yeah, absolutely. I mean, look, we're one of the things that we're most excited about here on the heels of the GCP acquisition pending this quarter is the opportunity to bring some of our innovation around the renewable energy space and marry it with the opportunity of data centers. I think as we've talked about in the past, we've actually made a meaningful investment in a company called X Energy, which is a large nuclear SMR business, recently in partnership with Amazon. And so I do think this is about obviously meeting the demand for compute and AI, but the power piece of it is a big part of the solve for.
What about in the wealth business? What can you tell us about opportunities? I mean, one of the exciting parts of the story for investors is the potential inclusion of more alternative products like yours in retirement plans, for instance. How focused are you on that? How much room for growth is there?
Yeah, so the wealth management business is a growing part of our distribution. Obviously, we have a large global institutional franchise with close to 3,000 institutional investors that we manage money for across the globe. Over the last 5 years, we've made meaningful investments in growing our product set as well as our distribution and servicing capability in the wealth channel. We actually had a record fundraising year last year and are currently raising about $1 billion plus of equity per month in the non-traded wealth space. And that puts us as the third largest player in that space today with a roughly 10% market share. That's just in the early innings. The retail investor is generally underallocated to alternatives. I think they are looking for tax advantages, differentiated equity exposures, non-correlation to things that they have in their liquid portfolio. 401ks obviously is getting a lot of attention. I still think we have a long way to go in order to get regulation and lawmaking that is necessary to see alts really proliferate in the DC channel, but it's something that we're obviously prepared for when that day comes.
Yeah, I'm probably pushing for it too. Finally, just on the overall environment, you alluded to more M&A, and look, there's a lot of excitement about capital markets activity. Ultimately, how much does it impact your business? You started out by saying policy sort of agnostic or watching, but how should we think about this sort of new era in the markets? Financials have really rallied, including your own stock, just given the change of environment.
Yeah, look, the animal spirits have been unleashed, and that's generally good for the business. You know, when money's in motion, you know, transactions are up, and generally that drives the business. But one of the things I think people are beginning to understand is how durable the private markets opportunity is across the different asset classes. And as we demonstrated last year and in 2023, oftentimes even when the markets are closed or the banks are de-risking, the private markets come in as a really creative solution provider into the market. So again, I'm optimistic that the pipelines are building and we're going to see that transaction activity pull through. But if it doesn't, then you begin to see things like secondaries, you know, opportunistic credit, opportunistic real estate kick in as well. So I think now we and most of the large global alt players are fairly well hedged against the market backdrop, regardless of which way it breaks.
Michael, appreciate the color and commentary around the results and the business and the environment. Always good to see you. Thank you.
You as well. Thank you very much.
Mike Arougheti.